The Bond King, the life, philosophy, and timeless lessons of Bill Gross. Good morning. It is a pleasure to be with you all once again as we continue our exploration of the master architects of the financial world. We have studied the global visionaries, the contrarian bargain hunters, and the masters of equity. Today, we turn our attention to a different realm, a market of immense scale and profound influence that often operates in the background of the flashier stock exchanges. We are speaking of the bond market, a vast ocean of debt where movements are measured not in points, but in basis points, 1/100th of a percentage point, and where the tides are dictated by central banks and macroeconomic currents. It is a market of whispers and subtle shifts, where fortunes are made and lost on the interpretation of an inflation report or the nuance of a central banker's speech. And in this complex, intricate, and often opaque world, one figure rose to a level of dominance and celebrity that earned him a title never bestowed before or since, the Bond King. His name is Bill Gross. For decades, he was the undisputed maestro of fixed income, the co-founder and driving force behind PIMCO, the Pacific Investment Management Company. His story is not one of picking individual winning stocks, but of making grand, sweeping, macroeconomic calls in the direction of interest rates, inflation, and the global economy, and then positioning a multi-trillion-dollar portfolio to profit from those views. He transformed the staid, conservative world of bond investing from a passive, buy-and-hold endeavor into an active, dynamic, total return strategy. His career offers a masterclass in macroeconomic insight, rigorous trade structuring, and the immense power and peril of conviction. It is a story that teaches us how to think about the invisible forces that move capital and the psychology required to bet against the consensus. Act 1, the making of a trader. From blackjack tables to the trading desk to understand Bill Gross, one must begin not in a Wall Street boardroom, but in the casinos of Las Vegas. This is not a trivial anecdote. It is the foundational crucible of his entire philosophy. After graduating from Duke University and serving in the Navy during the Vietnam War, Gross found himself at a crossroads, searching for a path that suited his unique mind. He enrolled in the MBA program at UCLA Anderson, but his real transformative education was happening on weekends in Las Vegas. He, along with a partner, developed a sophisticated system for counting cards in the game of blackjack. For a year, they lived in a hotel, dedicating 8 hours a day, 6 days a week, to the game, treating it not as a gambling pursuit, but as a statistical profession. They were eventually asked to leave, politely but firmly, but not before Gross had turned a humble $200 into $10,000. This experience was profoundly formative. It taught him the cold, hard mathematics of probability and risk. It ingrained in him a deep, intuitive understanding of the relationship between odds and payoff, the concept of expected value. Most importantly, it taught him the psychological discipline required to stick to a system in the face of short-term variance. It was the ability to lose a hand or a series of hands without panic, without emotion, without abandoning a strategy that was mathematically sound in the long run. In blackjack, variance is the noise, the system is the signal. These were the exact same skills required for successful trading, calculating odds, managing position size, and maintaining emotional equilibrium amidst the market's constant, often irrational, fluctuations. He learned that the market, like the blackjack table, doesn't care about your needs or your ego. It only responds to probabilities and disciplined action. Upon graduating, armed with this unusual training, he answered a newspaper ad for a junior bond analyst at Pacific Mutual Life. It was 1971, and the bond market was a sleepy backwater, the province of insurance companies and pension funds. Bonds were considered widow and orphan investments, boring instruments bought for their steady, predictable income and held dutifully to maturity. The very concept of actively trading them for capital gains was seen as radical, even reckless. But Gross, looking through his probabilistic lens, saw what others did not. He saw that bonds were not static, sleeping assets. They were dynamic securities whose prices moved inversely to interest rates. If interest rates fell, the fixed payments of an existing bond became more valuable, so its price rose. If rates rose, the opposite occurred. He realized that if you could forecast the direction of rates with better than average accuracy, you could make or lose a fortune. The bond market was not a place for sleepy income. It was an arena for capital appreciation disguised in plain sight. His big break, and the moment that would define his career, came in the early 1980s. The Federal Reserve, under the iron-willed Chairman Paul Volcker, had raised interest rates to unprecedented double-digit levels to crush the runaway inflation of the 1970s. This necessary but painful medicine had caused bond prices to collapse, creating a generational bear market. Panic and pessimism were rampant. But Gross, analyzing the macroeconomic landscape with a cool detachment, believed that Volcker's medicine was working. He foresaw not just a temporary dip in inflation, but a long secular decline, a multi-decade retreat of the inflationary dragon. Consequently, he predicted a long, powerful bull market for bonds, as falling interest rates would cause the price of existing bonds with their higher, locked-in coupons to soar. He convinced his skeptical superiors at Pacific Mutual to let him run a small bond portfolio with a new, heretical mandate: forget about holding to maturity, forget about just collecting the coupon. The goal was total return from both interest income and capital appreciation. He was given the leash, and he was spectacularly right. The great bond bull market that began in the early 1980s would run for nearly 4 decades, and Bill Gross was its most prescient, aggressive, and articulate pilot. His small experimental portfolio became the foundation for PIMCO, which he co-founded. The PIMCO Total Return Fund, the vessel for his strategy, would grow under his management into the largest mutual fund in the world, a financial supertanker at its peak, managing nearly $300 billion of other people's money. He had ridden a single brilliant insight to the pinnacle of the financial world. Act 2, the PIMCO machine, a new paradigm for fixed income. Bill Gross did not just participate in the bond bull market, he revolutionized how bonds were managed. He turned PIMCO's Newport Beach headquarters into a hybrid institution, part macroeconomic think tank, part high-tech trading floor. His approach was built on several core, interlocking pillars that defined his unique philosophy and created his edge. First and foremost was secular macroeconomic forecasting. Gross was not a stock picker. He was a top-down economist of the highest order. His entire investment process began with forming a long-term, or secular, view of the global economy. He and his team of PhDs would analyze deep trends in inflation, GDP growth, productivity, demographic shifts, central bank policy, and fiscal policy to form a 3 to 5 year outlook. This secular outlook was not a vague guess, it was the North Star, the strategic backbone for all of PIMCO's investment decisions. Every trade, every portfolio adjustment was a tactical expression of this grand strategic view. His correct early call on the long-term disinflationary trend, powered by globalization, technology, and vigilant central banks, was the single most important driver of his success. He understood that in fixed income, you are not betting on a company's management, but on the direction of entire economies and the policymakers who steer them. Second was the revolutionary concept of total return. This was his great intellectual innovation that changed the industry. Traditional bond managers focused narrowly on yield and safety of principal. Their job was to clip coupons and return the initial investment. Gross shifted the focus decisively to total return, the sum of a bond's interest payments plus its change in market price. This shift in mindset was monumental. It meant that selling a bond for a capital gain was just as valid, just as important as holding it for its coupon. It opened the door to active management, to selling bonds when they were expensive, when yields were low, and buying them when they were cheap, when yields were high. It transformed bond funds from static, income-generating utilities into dynamic, total return vehicles that could compete with equity funds. The bond manager was no longer a passive caretaker. He was an active driver, seeking capital growth from the most unlikely of places. Third was the sophisticated use of leverage and derivatives to generate alpha, or excess returns, in a market as vast, liquid, and efficient as the U.S. Treasury market. Gross and his team had to employ complex tools to amplify their insights. They used repurchase agreements, or repos, to borrow money cheaply short-term, using their bonds as collateral, thus amplifying their bets. More importantly, they masterfully used futures, options, and interest rate swaps. These derivatives allowed them to gain precise, leveraged exposure to interest rate movements, to hedge specific risks, and to implement nuanced views on the shape of the yield curve, whether it would steepen or flatten without having to buy the underlying bonds directly. This sophisticated toolkit allowed him to make high-conviction, asymmetrical bets that a traditional buy-and-hold manager could never even conceive of. He could express a view on German interest rates using a swap, or hedge U.S. duration risk with futures, all from his desk in California. Fourth, and the counterbalance to all this complexity, was a relentless focus on risk management. Despite his use of leverage and derivatives, Gross was, at his core, a risk manager. He often spoke of the potential for permanent impairment of capital as the greatest sin an investor can commit. He implemented strict firm-wide duration targets, duration being a measure of a bond portfolio's sensitivity to interest rate changes. A higher duration means more risk and more potential reward if rates fall. While he gave his portfolio managers leeway to deviate from the benchmark, it was within a tightly controlled, centrally monitored risk framework. He understood that to win the game, you first have to stay in the game. This philosophy was a direct echo of his blackjack days. You can have a winning system, but if you bet too much of your bankroll on a single hand, a run of bad variance can still wipe you out. At PIMCO, the house edge was their macroeconomic insight, and risk management was the rule that kept them from betting the entire bank. His famous investment outlook memos, which he began publishing in the 1980s, became must-read material for every finance minister, central banker, and professional investor in the world. They were a unique blend of rigorous economic analysis, sharp market commentary, and deeply personal, often whimsical musings on everything from politics to his beloved cat. They were the pulpit from which he unveiled his secular themes, most famously the new normal. After the 2008 financial crisis, his prescient warning of a world characterized by lower growth, higher regulation, and lower investment returns. These memos were not just a communication tool, they were a strategic weapon. They shaped market sentiment, attracted billions in client capital, and solidified his status as the bond king, the one voice everyone had to listen to. Act 3, the reign and the transition, the perils of power and the inevitability of change. For over 3 decades, Bill Gross's performance was nothing short of spectacular. The PIMCO Total Return Fund consistently outperformed its peers and its benchmark, often with less risk. He was hailed as a genius, an oracle. His word could move global bond markets. A single line in his monthly memo could cause yields to twitch across continents. However, the very concentration of power, the cult of personality, and the astronomical scale of his success eventually sowed the seeds of difficulty. In finance, scale is the enemy of agility, and prolonged success is the fuel for overconfidence. The first major test of his legend was the 2008 global financial crisis. Gross, who had long warned about the dangers of subprime mortgages and excessive leverage in the shadow banking system, positioned PIMCO aggressively to profit from the collapse. He loaded up on ultra-safe government, guaranteed securities, while avoiding toxic mortgage-backed debt. When the U.S. government, in its desperate efforts to stabilize the system, guaranteed money market funds and launched the unprecedented program of quantitative easing, essentially creating new money to buy bonds. Gross was perfectly positioned. He famously dubbed the new post-crisis investment landscape the new normal. He was one of the very few voices to not only navigate the cataclysm with prescience, but to emerge from it stronger, his legend burnished to a brilliant shine. However, the post-crisis environment of perpetually near-zero interest rates, engineered by central banks, presented a profound existential problem for his strategy. The great secular bull market in bonds, which had been the foundation of his fortune for 30 years, was reaching its logical, mathematical endpoint. With the 10-year Treasury yield plunging below 2%, the potential for further capital gains from falling rates was severely limited. The engine of total return was sputtering. In this challenging environment, Gross began to make bigger, more concentrated, and ultimately more controversial bets in a search for yield and performance. He made a huge, very public wrong-way bet on U.S. Treasuries in 2011, believing that rates would finally rise as the economy recovered. Instead, rates kept falling, and his fund suffered significant outflows and underperformance. He made a high-profile bearish bet on the deterioration of German government debt, which also failed to materialize. The magic touch seemed to be fading. Within PIMCO, tensions that had been simmering for years came to a boil. His management style, which had always been intense, demanding, and perfectionist, became a source of severe internal friction as the firm ballooned into a multi-trillion-dollar behemoth. His autocratic, centralized control clashed violently with a growing desire among other talented executives for a more collaborative institutional structure. The firm was no longer a boutique. It was a global asset manager that needed a different kind of leadership. In September of 2014, in a stunning move that shook the financial world to its core, Bill Gross abruptly resigned from PIMCO, the firm he had co-founded, named, and built into a global powerhouse. The Bond King had left his castle. The reasons were complex: a toxic brew of personality clashes, justifiable questions about his recent performance, and a fundamental struggle over the firm's future direction and culture. Just a month later, in a move seen as an attempt to reclaim his throne and prove his critics wrong, he joined a much smaller rival, Janus Henderson Group, to run a tiny, unconstrained bond fund. But the magic proved impossible to replicate. The scale was different. The deep bench of PIMCO resources was gone, and the market environment was uniquely challenging. The alpha had eroded. He announced his retirement from managing money in 2019, bringing a definitive and somewhat melancholic end to one of the most remarkable, influential, and dramatic runs in all of financial history. The timeless lessons for the modern investor. So, what enduring wisdom can we extract from the dramatic, triumphant, and ultimately cautionary career of Bill Gross? His lessons are not just about bonds. They are about navigating complexity, managing success, and understanding the cyclical nature of all things. They are particularly relevant in today's world of volatile interest rates, high debt, and complex financial instruments. 1. Understand the macroeconomic tide. Gross's career is a powerful testament to the paramount importance of a top-down, long-term economic view. While stock pickers focus on the micro-details of individual companies, the quality of management, the competitive moat bond investors must focus on the big picture, the tides of inflation, growth, and central bank policy. For any investor, understanding the prevailing secular trend, whether it is disinflation, reflation, or stagflation, provides an invaluable, overarching context for all investment decisions. It tells you which way the wind is blowing. Your asset allocation, which is driven by these macro views, is often the primary determinant of your long-term returns, more so than your individual stock picks. Gross teaches us to lift our eyes from the spreadsheet and look at the horizon. 2. Total return is the true measure of success. The shift from thinking about income to thinking about total return is a critical mental model for the modern era. Whether you are investing in stocks, bonds, real estate, or any other asset, your focus should be on the sum of all cash flows and price appreciation. This mindset liberates you from a yield-chasing trap and encourages a more dynamic, active, and rational approach to portfolio management. It forces you to ask the essential question, not just what is the yield, but is this asset priced in such a way that it can deliver a positive total return from here, given all the risks? It moves you from being a passive collector to an active allocator of capital. 3. Risk management is not optional. It is the entire game. Gross's sophisticated use of leverage and derivatives might seem esoteric to the individual investor, but the underlying principle is universal and deadly serious. You must always, always know your risks. For the individual investor, this means understanding the duration risk embedded in your bond funds, how much they could fall if rates rise. It means understanding the concentration risk in your stock portfolio and the liquidity risk in any alternative investments. It means diversifying properly across and within asset classes and avoiding the seductive but dangerous use of excessive margin. The goal is not to avoid risk. That is impossible. but to understand it, to quantify it as best you can, and to ensure that the potential return justifies taking it. As Gross showed, you can use complex tools to manage risk, but you must never ignore it. 4. Even the best systems can be broken by scale and ego. This is perhaps the most humbling lesson. Gross's initial phenomenal success was built on a brilliant, replicable system, a fusion of macroeconomic insight, probabilistic thinking borrowed from blackjack, and ironclad disciplined risk management. However, as his fund grew to an enormous market-moving size, his ability to nimbly enter and exit positions diminished. He became the market. Furthermore, a long, unbroken string of successes can breed a dangerous overconfidence, a belief in one's own infallibility. This can lead to larger, more concentrated bets that defy the very principles of position sizing and risk management that built the fortune in the first place. Success can blind you to your own vulnerabilities. The lesson for all of us is clear. Never let a winning streak convince you that the fundamental rules of the game, the rules of probability, humility, and risk, no longer apply to you. 5. All secular trends eventually end. The 40-year bull market in bonds was a once-in-a-generation or even once-in-a-century phenomenon. Investors who came of age during that period, who built careers on it, may have started to believe it was a permanent condition of the financial world. Gross's later career struggles are a stark personal reminder that market regimes change. The strategies, no matter how brilliant, that work spectacularly in one era may fail miserably in the next. The disinflationary wind that filled his sails for decades finally stilled. An investor must therefore be adaptable, must constantly question their core assumptions, and must be prepared mentally and strategically for paradigm shifts. What worked yesterday will not necessarily work tomorrow. In the final analysis, Bill Gross's legacy is a complex tapestry of brilliance, innovation, sheer power, and human fallibility. He demystified the bond market and provided a masterful roadmap for how to think about and profit from the grand, sweeping movements of the global economy. He showed that alpha can be generated in any asset class, even the most seemingly staid and boring, through deep insight, rigorous discipline, and a willingness to challenge convention. He was the quintessential active manager in an era that asked for it. His story is a powerful Shakespearean drama that illustrates a fundamental truth of the markets, that cycles govern not only economies and interest rates, but also the careers and reputations of the men and women who seek to master them. He was and will forever be the Bond King, a title earned through decades of unparalleled performance and market influence. Yet his story also serves as a poignant reminder that in the world of finance, true sovereignty is both incredibly powerful and inherently transient. It is a lesson in brilliance and a lesson in humility. Thank you.